Yesterday, we discussed that the economy is facing a stagnation, and at the same time, we have already discussed that China is likely going into a depression. This is leading some in the comments to rightfully question my belief that our stock market will face a, quote, volatile Nike swoosh recovery. Let's break this down and explain how our investments could be affected, in my opinion, based on the fact that, yes, we could actually be facing economic stagnation. Quick update, I am on autopilot on my way to a destination. I have to go fly somewhere. So we're gonna fly, and so we'll be on autopilot and we'll do this discussion. Okay, so let's keep this very clean. Yesterday, we made it clear that employment placement firms are suffering. Their earnings are going down, less white-collar workers are being hired. We are seeing more labor attrition, which is different from laying off people, but it's basically not hiring people who have otherwise left. And we are seeing a slowdown in consumer staples and consumer discretionaries across the board. So in other words, things people need to buy, they're buying less of. Things people want to buy, they're buying less of. This is corroborated at small and medium businesses and across all income thresholds. This is evidenced by American Express, Capital One, Target, Home Depot, Etsy. The list goes on. We know the stagnation is happening. And at the same time, we know China is probably in a depression. After all, if we rely on maybe 10 to 15% of our GDP is basically reliant on China, then is that not a possible way that we could fall into a recession? And the answer is absolutely, 110%. Yes, both of these. Remember, American consumers make up 72% of the economy. China contributes to our economy as well. After all, if they buy electrical machinery, which is one of the big things that they actually import from us, if they buy high-end machinery from us, machinery that isn't banned, well, that contributes to our domestic product, our gross domestic product, what we produce. Both of these things can absolutely contribute to stagnation, which is basically flat growth, or a recession, which could be a shallow recession. It could be a negative 0.1% for 2 quarters in a row, which is basically roughly what we had in the beginning of 2022, which leads a lot of people to say the recession is already behind us, but then the yield curve is still inverted, so everything's a little contorted. But the question is, people are asking, Kevin, the most important thing I care about is not, are we going to go in a recession or not? It's, how can you possibly say we're still going to be in a volatile Nike swoosh recovery? I'm going to make that answer exceptionally clear now. The stock market does not give a flying hoot what is happening today. You do. I do. As individuals, as humans, we care about what is happening today. But the stock market has a bizarre way of looking ahead 18 months. This is why when in May and towards the middle of April of 2020, after we got destroyed towards the end of February and all of March and a little bit of the beginning of April with COVID lockdowns and shut the economy and Bill Ackman lock everything down for 30 days and we knew we were going to be dealing with a massive nightmare of the economy. This is why we started seeing pain immediately, but it's also why by mid-April we realized, wait a minute, we're going to reopen, everything's going to go back to normal, everything's going to be glorious and great. Maybe there won't be other future waves of COVID. And the stock market very quickly rebounded while most of our country was still in lockdown and thousands of people were dying to the first strain of COVID, which was substantially more virulent than it is today in many regards. Okay, great. So we know that works. What else did the stock market do? The stock market started selling off in December of 2021, but inflation didn't peak until 7 to 8 months later, because the stock market prices in the pain that is to come for the next 18 months. Well, that pain might already be priced in all the way into December of 2022, which is why we've started having a recovery. My thesis has been the economy will see inflation trend down It will come down in volatile reports. It'll lead to a lot of fear in the economy, and we'll have a lot of ups and downs in the stock market. But we will generally trend up as people realize we have a big opportunity cost in sitting in cash and in bonds. And maybe it's time to be allocated to stocks again. And that's exactly what we saw in 2023. So we have to remember, number one, stock market is forward-looking. Number two, when we consider the forward-looking nature of the stock market, the little nonsense that we hear on the daily basis, like this morning we had, I think it was Bullard or Barkin, one of them, over at the Federal Reserve. Well, if the economy's doing stronger and inflation trends up, we might have to raise rates higher. All people hear from that is, if the economy is stronger, we have to raise rates. That's not what he said. What the Fed is saying is, if the economy is stronger and inflation is up, we then may have to raise rates more. But we can have a strong economy with falling inflation. We can recover after what we saw with Paul Volcker in '82 over the next 20 years with declining inflation and an overall strong economy with short periods of pain, like in '87 in the S&L crisis and some of the other issues towards the late '80s. But broadly, out of that 20-year period, you had pretty much 17 great years. You can have a strong stock market in the face of pain for the consumer. It's weird. Now, we have to go into the segments though. What do I personally believe will do the best? I want to be crystal clear about this. I do not think every single stock is going to do well. I despised the fact that Macy's did well during the pandemic because I thought this was a company trending towards being Sears and going bankrupt. And I still believe that. Yes, they've got a fantastic real estate portfolio, but what good does that do you in commercial real estate today? So, companies like these consumer goods and clothing and apparel companies, and even some of the beauty companies that have done really well, they've somewhat blown my mind. Okay, they've done very well, because I do think a weakening consumer is going to stagnate to lead to probably massively negative year-over-year earnings for these companies. Consumer staples, I think, will suffer. I've been saying that since December. And some of these consumer discretionaries that have really been propped up by COVID, like the Macy's or even beauty to some extent, I think had their run. I think now, where the money is and what can actually support the stock market, even in the face of these stocks declining, is going where the spending is. Sorry, I'm moving some coffee mugs. It's the Don't Sue Me Bro coffee mugs. Anyway, going where the spending is. Where is the spending in the economy today? It's simple. The spending, hands down, is at the biggest companies in America. Amazon, Google, Facebook, Tesla. This kind of spending, the spending that we have to build new chip factories by TSM, by Intel, via the CHIPS Act, the spending that we're getting contributing to energy subsidies, whether it is solar production or encouraging people to buy solar or to buy batteries or manufacturing of batteries in America. These are things that can actually keep us out of a recession. So as parts of the economy suffer, freight and some of the consumer discretionaries or staples, other economies can flourish. That's sort of a little bit of a yin and yang that you would expect in a normal economy anyway. Everything goes through different waves. But here's the other thing that's wild. Home building is exploding. Home building is a large part of our GDP estimate in America. Business fixed investment, or I should say, let me rephrase that, not business fixed investment. Residential fixed investment is expected to balloon in the first quarter of 2024, thanks to home builders realizing, prices hit their bottom. They're starting to trend up again. There are very few buyers, but prices are starting to trend up again, so we can still make profit on homes by building them and then selling them. Let's go build. Well, when we get that kind of investment, we hope that GDP can actually remain strong through the first half of 2024. And it does seem unlikely that we're going to hit a recession towards the end of 2023. So there is a possibility that we will avoid a recession. The inverted yield curve says we will not avoid a recession. But even if we go into a recession, remember the stock market is looking way beyond. The stock market is already beyond the 2024 election. Think about that. The stock market is already starting to price in 2025. And I think that's what folks have a hard time comprehending in the stock market. And it's okay, because it feels weird. Here we are, just past the middle of 2023. There are definitely still problems in the economy, and there's definitely still recession risk over the next 18 months, and the stock market's already looking past it. Because most of the market does not believe that we are going to have a high inflation problem for long. The real debate is actually, okay, well, are rates just going to stay higher for longer through 2025? Are they ever going to go back to 0%? Okay, but that doesn't mean you have to go back to December of 2022 lows or July of 2022 lows. Does that potentially limit how high the stock market can go? Absolutely. If we went back to zero interest rates, the NASDAQ would be 20 to 30% higher, just solely based on inflation, than where it was in November of 2021. I strongly believe that. We'd be 20 to 30% higher than where we were in November of 2021. Simply inflation adjusting the stock market. If we went back to ZERP, but the market isn't necessarily pricing in ZERP. Oh, I pulled too far away. Oh, I got it. I think the market is probably pricing in a return to somewhere around 2%, 2.5% interest rates by 2025, middle of 2025, not necessarily back to zero. And if we go back to zero, be even better. So this is why I'm doing my best to align my portfolio with companies that I believe have enterprise pricing power and higher end consumer products that people are going to want to buy no matter what happens in the economy. And so that I find is very interesting. So I don't have the perfect answers to that, but I do believe there is a strong case to be made for the cloud service providers, the Googles, the Amazons, the Facebook. I've been very impressed with Meta's numbers. I admit I have never been very excited about them, but I've been pretty impressed with them. And as far as obviously NVIDIA, the chip makers, the chip stack, very excited about those. So I think that's the balance that out with solar. Thanks so much. I gotta go. Appreciate y'all. I'm gonna upload this video now. We'll see you soon. Oh, and look, we got 69 4 PP on the plane now, which finally matches.